Welcome to the Deep Dive. You've tasked us with making sense of Southwest Gas Holdings' second quarter 2025 earnings call. That happened back on August 6th.
Right.
Today, we're really going to cut straight to the core, give you the essential insights.
Yeah, get past the headlines.
Exactly.
Yeah.
This isn't just a summary. It's your deep dive into what truly matters from their latest statements. Let's see what story Southwest Gas telling.
Okay, let's do it.
So let's jump straight into the numbers, because on the surface, Southwest Gas Holdings delivered what looks like, well, a bit of a mixed bag for Q2 2025. Certainly got people talking.
Indeed. What immediately jumps out, I think, is that non-GAAP EPS. They posted 53 cents.
Right.
Now, that non-GAAP figure, that's their adjusted earnings, basically stripping out some one-off items to get a clearer view of core operations. And that 73 cents, well, it pretty handily beat the consensus estimate of $0.42. So that's a strong operational beat. The underlying business did better than expected.
Okay, so a definite positive on the operational side. But here's where it gets maybe a bit tricky. The company also recorded a GAAP EPS loss of under $0.18. Now, GAAP, that's the official accounting number, includes everything.
Right, no adjustments there.
And that's a big swing from a positive $1.25 just last year.
And that difference, that divergence, is really key to understanding how the market reacted initially. You see operational strength in the adjusted numbers.
But then that GAAP loss, it's substantial on paper.
Exactly. And then you add revenue. It came in at $1.120 billion.
Which missed the estimate, right? The $1.17 billion.
Yeah, missed that. And it was also down 5% compared to last year. So we're balancing this operational beat with a significant accounting loss and a revenue miss on the top line.
That's quite a bit to sort through, isn't it?
It is.
And for anyone trying to figure out these signals, the market's reaction was pretty telling. Shares sort of drifted lower throughout the day of the call.
Suggests investors were looking closely, maybe weighing that gap loss and the revenue softness against the good adjusted earnings number.
Yeah, it seems like the market wanted more context. So what's the real story here? What did management actually emphasize?
Well, the main narrative from management was very clear. It was about this strategic pivot, a real determined push towards becoming a pure-play regulated utility.
Okay.
And this isn't just talk, right? They pointed to actual regulatory wins, a stronger balance sheet. This bigger picture really frames everything else, including that GAAP loss.
So let's dig into that. That non-GAAP EPS beat, the $1.53 one, showing operational strength, what was really behind it. Is it, sustainable?
Good question. For you, the key thing is it was primarily fueled by higher utility margins.
Okay.
And that came directly from getting rate relief approved and just continued solid customer growth in their areas. It really speaks to the health of the core utility business.
Right.
In fact, the utility segment's contribution to net income actually went up by $6.1 million year over year. It hit $33.7 million.
Yep.
And if you look at adjusted consolidated net income, sort of a broader view of underlying health, that saw an even bigger jump, up $16.1 million to $38.6 million. So yeah, strong ongoing performance in the main business.
That definitely paints a picture of operational health. But then we still have that $96.18 GAAP loss per share. That's a headline number, makes you pause.
For sure.
What's the real story there? Should we be worried?
Well, that GAAP loss, while it catches your eye, it seems to reveal more about a strategic move than some kind of operational failure.
Ah, okay.
Management basically said it was largely due to tax effects, specifically related to the ongoing Centuri share sales.
The divestment.
Exactly. The real insight here is they're kind of deliberately taking a short-term accounting hit now to help solidify that long-term pure-play utility strategy.
Makes sense.
And they expect these tax effects will be partially offset by lower tax expenses down the road once they fully sell off the rest of Centuri. So it's less about a failing business, more about the financial impact of a strategic choice, one that could lead to more stable earnings later.
That's a really important distinction. Okay, what about the revenue decline? 5% year over year could look like weakening demand, but you said that was also nuanced.
It absolutely is. The revenue dip was mainly due to something called commodity pass-through effects.
Okay, explain that.
It just means the cost of the natural gas itself was lower during the quarter, and utilities, being regulated, typically pass that cost directly to customers. They don't really profit from the commodity price itself.
Ah, so lower cost of gas means lower reported revenue, even if they delivered the same amount.
Precisely. So while the raw revenue number went down, it doesn't mean less demand or losing customers. It just reflects passing lower fuel costs through. Underlying demand for gas in their areas is actually still quite strong.
Got it. They're out making less money delivering the gas, just the pass-through cost was lower.
Okay, shifting to their financial foundation. You mentioned strong health, over $356 million cash, over $1 billion in total liquidity. That sounds pretty comfortable, especially for a utility. It definitely is. Shows they can manage operations, fund investments, and it brings up, how efficiently are they using that capital?
Right.
Well, their utilities trailing 12-month return on equity, the ROE, it actually improved up to 8.3% from 8% in the 2 previous years.
So getting better returns on their investment.
Exactly. Reflects better operational efficiency, moving things in the right direction.
And speaking of efficiency, you noted year-to-date operating and maintenance costs only rose just over 2%. It's below inflation.
Indicates good cost discipline at the utility level. Always a good sign. Management keeping costs in check.
Okay.
Another, maybe slightly complex shift was the deferred purchased gas cost balance, the PGA.
Right, the PGA.
It flipped from an $82 million asset last year to a $349 million liability this year.
Whoa, big swing. What does that mean practically?
Well, PGA balances track the difference between what they paid for gas and what they collected from customers in rates. That big flip to a liability means they'd significantly over-collected from customers recently, likely due to falling gas prices.
Okay, so they had too much of the customer's money, essentially.
In simple terms, yes, but they addressed it. They got approval for energy credits for Nevada customers starting July 1st, specifically to give back those over-collected amounts faster. It's an accounting thing, but it has real impact for customers and helps stabilize their books on that front.
Okay, so that makes sense. Now, if we're looking for the main event this quarter, it feels like it's the Centuri separation. We've been watching this, and now there's real momentum.
Absolutely. This is truly a pivotal moment for them. They pulled off 2 secondary public offerings and these concurrent private placements in May and June.
And that generated serious cash.
Over $470 million in net proceeds. That's a significant chunk of change.
And crucially, used to pay down debt.
Exactly. Straight to strengthening the balance sheet. That ties right back to improving their financial profile, cutting risk, making them look more like that pure play utility they want to be.
Makes sense.
So after those sales, their stake in Centuri is down to about 52.1%.
Still majority, but getting closer.
Right. And management repeated they're committed to finishing the separation in a way that gets the best value for shareholders. Could be more sell downs, maybe share exchanges, maybe a mix.
Okay.
And importantly, because these sales were successful, they said they don't expect to issue new equity under their ATM program in 2025.
Ah, the at-the-market program. So no gradual share sales diluting existing holders.
Exactly. That's a big relief for shareholders, avoids potential dilution, shows they're executing well on this key strategy.
That is a big vote of confidence in their financing plan. Now, they also talked up some positive regulatory developments. For a utility, that's often where the real action is, right? The rules they operate under.
Absolutely. It dictates how they recover costs and earn returns. In Arizona, they got approval for a capital tracker called the System Integrity Mechanism, or SIM.
SIM, what does that do?
It lets them recover costs for investments that don't directly produce new revenue, safety upgrades, modernizing pipelines, environmental stuff. The big deal here is it cuts down on regulatory lag. That's the delay between spending money on needed upgrades and actually getting approval to include those costs in customer rates. SIM speeds that up.
Sounds like a clear win then. But there was a catch, wasn't there?
There usually is. The Arizona Commission put a $50 million cap on the amount of capital that qualifies for the SIM each year. That wasn't in the original deal they discussed.
So a bit of a limitation. What are they doing about that?
They're looking at options. Could file for a rehearing, could just use the SIM with the cap, or maybe they file their next big rate case in Arizona sooner than planned.
Okay.
And the commission is also holding a workshop later in August about natural gas infrastructure needs in the state, so the conversation is ongoing. Shows how dynamic this regulation stuff can be.
Meanwhile, over in Nevada, Governor Lombardo signed SB 417 into law back in June. Sounds like that could be a pretty big deal for the regulatory setup there.
Yeah, what's really interesting here is this new law lets gas utilities pursue alternative rate-making mechanisms. Things like formula rates, multi-year rate plans, performance-based rates.
Okay, break those down quickly.
Formula rates allow more automatic, frequent rate adjustments based on set metrics again, cutting regulatory lag. Multi-year plans offer more long-term predictability. Performance-based rates can link earnings to hitting certain goals, like service quality.
And Southwest Gas has a preference.
They're focused on implementing formula rates. They think it'll really help reduce lag and improve cost recovery. They also said they don't see a reason to delay their next Nevada rate case because of this. They think the new law will actually work well alongside it. Could be a powerful tool for stability.
In California. Any news there?
Yeah, they mentioned an agreement in principle has been reached for their pending rate case there. New rates are expected around January 2026.
Okay, so despite that Arizona cap wrinkle, it sounds like generally positive movement on the regulatory front across their states, moving towards more stable, maybe more predictable frameworks.
That seems to be the trend, yes. More tools to reduce that lag and align investment with recovery.
You know, we've talked a lot about stability, cost control. But what about growth? Where's the future engine? And that seems to be this Great Basin Transmission 2028 expansion project.
Absolutely. This isn't just routine pipeline work.
Right. It's a response to huge new demand, especially from, well, a kind of surprising place.
It is. After they extended and reopened the sign-up period, the total interest from potential shippers jumped to about 1.76 billion cubic feet per day, BCFD.
That's a lot of gas.
It's massive. And the demand is particularly strong from these huge, rapidly expanding supercomputing and data centers popping up in the region.
The tech connection. The cloud needs power.
And lots of it.
Yeah.
Those facilities have incredible energy needs, and that's becoming a major driver for new natural gas infrastructure.
So that increased demand translates into a big potential investment for Southwest Gas, right?
Yeah.
Like $1.2 to $1.6 billion.
Exactly. A huge capital expenditure opportunity, clearly driven by real market demand. It's a big project. Target and service date is November 2028. They're aiming to finalize deals with the shippers in Q3 this year, 2025, and then file for the big FERC certificate, the main approval, in Q4 2026. It's definitely a major long-term growth driver with clear steps ahead.
Okay, shifting back to the near-term financials, they reaffirmed their 2025 guidance for utility net income.
They did. Kept it in the range of $265 million to $275 million. Shows confidence in the core business despite that Q2 GAAP hiccup.
And they laid out a 5-year capital plan, too.
Yep, $4.3 billion total for 2025 through 2029. Focused on safety, reliability, but also economic growth in their areas. That's the foundation for expanding their rate base.
And here's a key detail, I think. That $4.3 billion, it does not yet include any potential spending from that huge Great Basin expansion project we just talked about.
That's right. So the actual long-term growth from capital investment could be significantly larger than what's currently penciled into that 5-year plan. And that planned $4.3 billion investment, they project it'll translate into a compound annual growth rate in their rate base, that's the asset value they earn returns on, of about 6% to 8% over that period.
Solid, predictable growth.
And they broke it down. Half the spending is safety and reliability. About 30% is for economic development and business growth, so a balanced approach.
And proving that growth is happening, they added about 40,000 new meters in the last year.
Yeah, it represents about 1.8% customer growth.
Yeah.
Solid, consistent additions driven by the demand in the regions they serve.
Okay, and one last point on finances. Debt management.
They tidied things up there, too. Extended a term loan, but reduced the amount to $225 million out to June 2026. And they replaced a $300 million revolving credit facility, pushing its maturity out to August 2029.
Securing liquidity for longer.
Right. Shows effective debt management. And they also said they don't expect to need to issue significant new debt in the capital markets until sometime in 2026. Good for their financing costs.
Okay, so we've broken down the results, the strategy, the big projects. Now let's synthesize. For you, the listener, tracking this company, what does it all really mean? What's the big picture?
Well, this deep dive, I think it strongly underlines Southwest Gas's really determined shift to becoming a pure-play regulated utility.
Right.
That strategic move is all about making things clearer for investors, maybe closing that valuation gap they might have compared to other pure utilities. It's about simplifying the story.
So potentially a more predictable, maybe more highly valued business long term.
That's the goal. And for you, that successful debt reduction from selling Centuri shares really strengthens the balance sheet. That's critical for their credit ratings, future investments. It signals resilience.
Yeah, that improved financial footing is definitely a positive.
And those regulatory wins, especially in Arizona and Nevada with the new mechanisms like SIM and formula rates, they're crucial.
Why?
because they promise to cut that regulatory lag, ensure they get timely recovery for their infrastructure spending.
Yep.
That offers much greater earning stability and predictability, and those are qualities utility investors really value. For your thesis, it means more reliable future cash flows.
And the Great Basin Transmission expansion, that highlights real, robust energy needs, especially from data centers. That huge project offers significant rate-based growth potential, maybe even beyond what's in the current plan. Could be a major catalyst for future earnings that maybe the market isn't fully appreciating yet.
It could be. So while the market reacted a bit cautiously at first to the GAAP loss and the revenue miss,
Understandably.
right. But the underlying message seems to be operational improvement, clear strategic focus, and these constructive regulatory environments. It positions the company for long-term growth in weight base and earnings. And finishing that Centuri separation is still a key catalyst that could unlock more value just by simplifying the structure, make Southwest Gas a clearer bet for you.
All right, this is the deep dive, and you know what time it is, our This Is Not Financial Advice segment. Let's hear a wild but maybe plausible trade idea for Southwest Gas.
Okay, so given this clear pivot to being a pure play utility and all these new regulatory tools they're getting,
Right.
I'm pitching something I'll call the regulatory arbitrage play.
Okay. Intriguing.
The core idea for you is go long Southwest Gas. But at the same time, you initiate a short position on a basket of other regional utilities, specifically ones that don't have these kinds of advanced regulatory mechanisms or maybe have more complicated, less focused businesses.
So betting on Southwest Gas outperforming this other group.
Exactly. The thesis is that SWX's improved regulatory certainty, plus that embedded growth from the Great Basin project, plus the cleaner balance sheet after Centuri, all that will lead to a re-rating where its valuation improves significantly faster than its peers who are maybe stuck in older regulatory models or are more diversified. Our view here is that the market's current fixation on the Q2 GAAP loss and the revenue miss, it kind of overlooks these fundamental structural improvements that should drive better earnings quality and rate-based growth down the line.
So it's a bet that the market eventually catches up.
It's a bet the market eventually recognizes the superior regulatory setup and the pure play focus, and that causes the valuation gap or spread between SWX and that lagging utility basket to shrink significantly.
Interesting. Definitely plausible, if not a sure thing. Okay, let's recap our deep dive. Southwest Gas Holdings, Q2 2025, delivered a strong adjusted EPS beat.
Yep, mainly driven by utility growth and rate relief. That GAAP loss was largely due to strategic tax effects from the Centuri sales.
The company's making really significant progress on its strategic shift towards being a pure-play regulated utility.
Bolstered by paying down debt from selling Centuri shares and getting those key regulatory approvals in Arizona and Nevada that should lead to more earnings stability.
And that expanded Great Basin Transmission project looks like a really substantial future growth opportunity, set to meet critical energy demand, especially from sectors like data centers.
Right. So while the market's initial reaction was maybe a bit muted,
Understandably cautious.
the long-term outlook for growing their rate base and earnings, supported by better regulation and a clear strategy, looks pretty compelling. Management seems to be making deliberate moves to really set the stage for a potentially transformed company.
This concludes our deep dive into Southwest Gas Holdings Q2 2025 earnings call. As always, we encourage you to do your own research, your own analysis, and maybe ask yourself, how much value does the market still need to unlock in a company so clearly focused on its new identity?
Thanks for tuning in.